What if I told you that the difference between a retirement that feels like constant compromise and one that feels secure, flexible, and dignified can fit in the palm of your hand? Not a complex hedge fund, not a secret stock, not a trend you have to babysit every minute. Just 50 ounces of a dense heavy metal that hasn't missed a single day of purchasing power over thousands of years. You might roll your eyes and say, "Gold, again?" But suspend disbelief for just a moment and actually see the math. Because if you do, you'll understand why 50 ounces isn't a slogan. It's a plan, a bridge, and in many scenarios, a lifesaver. Picture this. You're 60 or 65, or maybe even already retired. You've spent decades building a nest egg through diligence and discipline. You didn't chase speculative bubbles. You saved in your 401k or IRA, maybe you own a home, maybe you have a small portfolio of broad index funds, but the ground under that retirement is shifting, sometimes slowly, sometimes violently. Prices creep up. Healthcare premiums make a mockery of your estimates. Markets swing at the worst possible time. The question isn't whether you've been smart. The question is how you protect what you've already built from forces you can't control. And that's where 50 ounces becomes more than a number. It becomes a ballast in the boat when the weather turns. Let's start with the simplest calculation, today's value. If gold is roughly in the mid-2000s per ounce, call it $2,300 to keep the math easy, 50 ounces is $115,000. If it's $2,500, that's $125,000. If it's $2,000, that's $100,000. That alone may feel like a meaningful slice of a portfolio, but the power isn't just the nominal value today. It's the way those 50 ounces transform risk and purchasing power in the years that matter most, the 5 to 10 years straddling retirement and the 20-plus years after. Here's the math no one shows you in a glossy brochure. At 3% annual inflation, long-term average in developed economies, prices will roughly double in 24 years. That means $50,000 of yearly expenses today becomes $100,000 by your late 80s. If you're retiring with, say, $800,000, a traditional 4% withdrawal rule starts you at $32,000 in year one. If the market cooperates, you might adjust for inflation each year, but that presumes a steady sequence of returns. In reality, a 30% drawdown in the first 2 years of retirement can permanently impair your outcome, even if the market recovers later. That's sequence of returns risk, the mathematics of bad timing that punishes you for needing income when prices are down. So what can 50 ounces do against that? Let's be clinical. Scenario A, no gold buffer. You retire with $800,000, pull $32,000 in year one, markets drop 25%. Now your $768,000 after withdrawal becomes $576,000. Year two, you need to pull $33,000 to adjust for inflation, and you're pulling from a depressed base. Even with a recovery later, the compounding curve has been bent downward at the worst possible time. Scenario B, 50-ounce buffer. Same retirement, but you dedicate 50 ounces as an income shock absorber. Year one, markets drop 25%. Instead of pulling from your stocks, bonds at a loss, you sell 10 ounces at, say, $2,300 each, $23,000, and combine with smaller portfolio withdrawals to meet your $32,000 need without forcing sales at the trough. If gold behaves like it historically does during stress, rising or at least holding steady, you're selling an asset that didn't get hammered to protect the assets that did. That simple act, selling what's strong to protect what's weak, compounds the difference across decades. That's the spend-down math. Now let's flip to purchasing power. Think in baskets of goods, not dollars. In the 1970s, gold rose from about $35 to over $800 amid inflation and policy shifts, a 20 times move. In the 2000s, gold advanced roughly 6 to 7 times from its bear market base to its 2011 high as debt built, rates fell, and the dollar's purchasing power eroded. You don't need a 7x to win. You just need those 50 ounces to hold purchasing power over 20 to 30 years while fiat erodes, because your groceries, insurance, travel, and healthcare bills are paid in dollars, euros, or pounds, not CPI indexes. Gold doesn't promise profit, it promises persistence. When you lay that against a 25 to 30-year retirement horizon, the compounding effect of not losing purchasing power is powerful. Let's attach numbers. Suppose inflation averages 3% for 25 years. The price level will be about 2.09 times today. If your $800,000 nest egg just keeps up with inflation in nominal terms, zero real return, it needs to become approximately $1.67 million just to break even in purchasing power. That's a big ask. But those 50 ounces? Historically, across multi-decade windows, gold's purchasing power over the long term has been comparatively stable in real terms. Volatile in any 3-year window, yes, but resilient in 20-year windows, especially around monetary transitions. If those same 50 ounces simply maintain real value, then in 25 years, their nominal value will mirror the price level. If an ounce is $2,300 today, and prices double over 25 years, keeping up points to $4,600 per ounce as a baseline scenario. That would make 50 ounces worth $230,000 in nominal dollars 2.5 decades from now. Roughly the same groceries, same utilities, same insurance, different dollar. Now imagine even a moderate tailwind, a plausible one rooted in monetary structure. Many retirees misunderstand what drives gold. It's not just CPI prints, it's real yields, nominal yields minus inflation, debt sustainability, and the credibility of the monetary anchor. When real yields are deeply negative, gold tends to shine. When debt to GDP ratios challenge sustainability and central banks quietly rebalance reserves toward harder assets, gold tends to reprice as the trust premium embedded in paper promises. This is why, in 2022 and 2023, we saw central banks purchase gold at or near record levels, an institutional behavior signal that long-term players are hedging currency and counterparty risk. They are not buying for 6 months. They're buying for 10 to 20 years, your retirement horizon. Let's zoom into the structure under the surface, because a lot of gold's mystery becomes obvious once you understand how the market is built. There's a paper market where futures and forwards trade. Think COMEX in New York, LBMA in London. And there's the physical market, bars, coins, allocated vaulted metal. Paper instruments allow price discovery with leverage. Physical instruments anchor settlement and ultimate ownership. In normal times, paper and physical trade in sync. In stress regimes, liquidity squeezes, delivery hesitations, refinery bottlenecks. You can see momentary dislocations where the cost to get actual bars rises relative to quoted paper prices. That premium is a message from the market. Promises are easy, delivery is hard. For a retiree, it's the difference between owning a number on a statement and holding something that doesn't care about counterparties. If your goal is to reduce fragility, the specific type of gold exposure matters. Now add another layer, ETFs, particularly the big, widely traded funds. Inflows and outflows from these funds can influence short-term ranges. Heavy outflows and risk-on equity periods can weigh on spot prices even as physical premiums rise in local markets. Conversely, risk-off environments can see surges of ETF buying. The institutional dance sometimes obscures the bigger picture. Over multi-year cycles, accumulation by central banks and long-horizon investors tightens the float of available physical, which eventually forces repricing when macro conditions demand a new equilibrium. You don't need to front-run every wiggle. You need to own enough of the real thing to ensure your long-term purchasing power isn't hostage to those wiggles. Let's address the technical structure briefly but clearly. Multi-year charts show that when gold breaks decisively above prior all-time highs and then respects those levels on pullbacks, the market is telegraphing a regime change. Think of it like a home that finally sells above the highest neighborhood comp, and then every new listing uses that sale to justify similar prices. In markets, that comp is the prior high. Once cleared and defended, the path of least resistance often becomes higher, especially if the breakout coincides with macro tailwinds like debt monetization, slowing real growth, or central bank reserve rotation. Measured moves from large consolidation patterns, say a multi-year range a few $100s deep, tend to project future targets of a similar magnitude above the breakout zone. So if gold spent years building energy in a $300 to $500 range and then escapes, technical frameworks suggest multi-$100 increments of upside as part of the price discovery phase. That's not hopium, that's market structure. But technicals and institutions only explain the how. The why that matters to you is simple. You can convert 50 ounces into income precisely when your other assets are under stress, without cannibalizing the goose that lays the eggs. Consider the bucket strategy many planners propose. Near-term cash bucket, 1 to 2 years expenses. Intermediate bonds, equities bucket, 5 to 7 years, and a long-term growth bucket. Gold fits into this architecture as an anti-correlation shock absorber, a separate bucket that you tap in crisis years. Imagine allocating 50 ounces across 5 crisis years of retirement. In each of those years, you draw 8 to 12 ounces instead of selling stocks 30% down. At $2,300 to $2,800 per ounce, that's $18,400 to $33,600 of purchasing power per crisis year, depending on price. That buys time. Time for dividends to keep flowing, for prices to normalize, for the recovery to lift your other buckets. There's no more important asset in retirement than time. Now, if the title of today's discussion is making you think, okay, but will it really save my retirement? Let's put guardrails around that claim. Nothing saves a plan that's dramatically underfunded. Nothing replaces the importance of reasonable spending, insurance, and controlling debt. But if you have a solid base, say $500,000 to $1,500,000 across accounts, then 50 ounces acts like a linchpin. It's a way to convert systemic risk into localized stress you can manage. That's what SAVE means here. Not a lottery ticket, but a shock absorber that prevents a bad 2-year stretch from wrecking a 25-year journey. Let's go deeper into purchasing power stories, because they illuminate the math better than any formula. In the early 1970s, before the dollar floated freely, you could buy a mid-range sedan for roughly 20 to 30 ounces of gold. In various cycles since, that ratio has meandered, but it keeps coming back to a simple reality. An ounce of gold tends to buy a meaningful slice of a human's basic consumption basket, decade after decade. Sometimes you can buy more with an ounce, sometimes less. But across 20 to 30 years, the seesaw often balances near an equilibrium. It's the nature of a monetary asset with no liability attached. Dollars are someone else's liability. Bonds are someone else's promise. Gold simply is. When a liar's dividend accrues in financial markets, promises stretched by low rates and high leverage, gold is the independent auditor. Now consider the healthcare elephant. If you're planning a 25-year retirement, healthcare can easily consume $300,000 to $500,000 in lifetime spend for a couple, depending on country, coverage, and unforeseen events. Those costs don't move politely with CPI. They surge, then plateau, then surge again. In inflationary bursts, your policy costs can jump 10 to 20% in a single renewal cycle. Selling stocks during those jumps magnifies harm. Selling 2 to 5 ounces that year, precisely when the rest of your portfolio might be flat or down, lowers the blood pressure. Saving your retirement often looks less like jackpot gains and more like prevention of forced harmful actions. Gold is the asset that pays you permission slips to wait. But what if we play out a few forward paths with numbers? Assume 3 inflation return regimes across a 20-year retirement starting at age 65 with $1 million plus 50 ounces of gold and $50,000 of annual spending, today's dollars. Regime 1, mild inflation 2%, steady markets 6% nominal. Your portfolio grows approximately 4% real after inflation, comfortably supporting the 4% rule. Gold likely tracks sideways to modestly up in nominal terms. You rarely need to sell it. The 50 ounces become your ultimate emergency fund, and maybe in your 80s you sell a portion to top up a higher level of care. Math. If gold goes from $2,300 to $3,400 over 20 years, about 2% real plus inflation, 50 ounces becomes $170,000. It's not a moonshot, it's a floor. Regime 2, moderate inflation 3 to 4%, volatile markets 4% nominal. Real returns compress to 0 to 1% before fees and taxes. Sequence of returns risk looms large. You deploy the gold 2 to 4 times across the first decade, say $25,000 equivalent each time, 8 to 10 ounces per event. You avoid selling stocks down 30%. The compounding spared from those forced sales is worth far more than the gold sold. If gold tracked inflation plus a small premium, your remaining ounces still hold their own. Math. 4 crisis years, x $25,000 equals $100,000 covered by gold sales, preserving perhaps $150,000 to $250,000 of eventual portfolio value that would have been lost to selling low. That is saving in action. Regime 3. High inflation 5 to 8%, financial repression, choppy markets 2 to 3%, nominal. Real returns in financial assets are negative after inflation. Governments keep rates below inflation to manage debt burdens. Gold acts as a relief valve. It tends to break previous ranges and reprice in lurches. Your 50 ounces could appreciate to $4,500, $6,000, $8,000 per ounce across the cycle depending on policy and trust. That's $225,000 to $400,000 of crisis-agnostic purchasing power. You may end the 20-year span with fewer ounces, but you arrive with dignity intact because the purchasing power of your withdrawals didn't depend entirely on suppressed real returns. Now let's talk about institution-level behavior. The behavior that telegraphs not the next week of price action, but the next decade of monetary structure. Central banks have been net buyers in recent years, with certain countries explicitly diversifying reserves away from sole reliance on the US dollar. This isn't collapse theater. It's prudent diversification given geopolitical and sanction risks in a multipolar world. When institutions with 100-year horizons buy, they aren't chasing a trade. They are sending a message about the nature of sovereign risk and the role of neutral reserve assets. For a retiree, the takeaway is not to mimic central banks tick for tick, but to understand their time horizon. If they're positioning for stability across uncertain currency regimes, you can too, at your scale. Zoom back into mechanics for one moment. COMEX, open interest and registered stocks, LBMA vault data, refinery utilization. In ordinary times, these plumbing details feel esoteric. In stress, they matter. Periods where open interest, effectively the promises to deliver, balloons relative to registered ounces, the barrels in the warehouse ready for pickup, create conditions where pricing is determined by confidence in smooth rollovers and net cash settlements. Again, this is a normal feature of modern markets. But if confidence is shaken, say, due to logistics, sanctions, holidays in major trading hubs, or a squeeze in physical bars, price can gap and premiums can widen. That's the scenario where owning actual ounces, not derivatives, becomes decisive. If your plan is built around using 50 ounces in stress years, you want those ounces to be accessible and unencumbered. The method matters: allocated vaulted bars, direct possession subject to your jurisdiction's best practices, or properly structured retirement account exposure to physical. The math only works if the asset is there when you need it. By the way, if phrases like allocated and unencumbered are new to you, think of it in simple terms. Do you own a bar with your name on it that cannot be lent out without your permission? Or do you own a share in a pool where bars can be shuffled, lent, or otherwise encumbered? Both have roles, but they're not the same. In retirement, certainty beats abstraction. The purpose of these 50 ounces is not speculation. It's clarity. Let's take a brief detour into history, because these cycles rhyme. In 1971, convertibility ended, an administrative act that rewrote money's rules. Gold didn't rally because of fairy dust. It repriced because the promise anchor changed. In 1980, after a blow-off top amid a vortex of inflation and fear, gold corrected brutally, reminding everyone that nothing goes straight up. In 2008, during the global financial crisis, gold experienced liquidation alongside everything else, then became a refuge as policy shifted to extraordinary measures. In 2011, amid the Eurozone crisis and QE debates, gold again repriced investors' anxiety about systemic promises. The through line is not that gold always goes up, it's that in regimes where promises are stretched, gold revalues. That's the math of trust. Now imagine a character, a retiree named Elena. She's 66, enters retirement with $900,000 split between an IRA, a taxable account, and the equity in her home. She listens to conventional wisdom and puts 60% in stocks, 35% in bonds, 5% in cash. No gold. The first 3 years of her retirement are rough: a recession, then a jagged recovery, then stubborn inflation. Her bonds don't behave like she expected because yields rose from a low base, zapping her bond prices. Her stocks whipsaw. She wants to wait, but she needs $48,000 per year after tax. She sells at bad times, pays taxes, and watches a slow leak that becomes a stream. Now take the same Elena, but she dedicates 50 ounces, call it $115,000 at today's notional price, as a crisis bucket. Year one's drawdown? She sells 8 ounces, $18,400 at $2,300 per ounce, to cover roughly 1/3 of her annual need, allowing her to sell fewer battered assets. Year 2? Markets are flat, inflation bites. She sells 6 ounces, $13,800 at the same price, and trims expenses slightly. Year 3? Recovery. She doesn't sell any. She ends the rough patch with 36 ounces left and a portfolio that never took the critical sequence-damaging hit. If gold appreciated during the stress, say to $2,600 per ounce, her remaining 36 ounces are now still worth $93,600. She spent resilience when it was most valuable and preserved compounding in her core. If you're hearing this and thinking, that sounds reasonable, but what if gold doesn't rise? Good. Build your plan on conservative expectations. If gold simply treads water, those 50 ounces still deliver liquidity that doesn't correlate with your stocks and bonds. You're not relying on a price spike, you're relying on independence. If gold underperforms for a period, you still have the optionality to defer selling other assets until a better time. Optionality has value. If the underperformance persists across decades and stocks thrive, then your retirement is solid anyway, and the gold served as insurance you didn't end up needing. That's a fine result. Let's weave in the why now of this moment. Debt levels are high. The path to reining in debt to GDP meaningfully without pain is narrow. Historically, the policy toolkit oscillates between fiscal restraint, politically difficult, financial repression, keeping rates below inflation, and growth miracles, rare. In repression regimes, savers bear the hidden tax, negative real yields. Gold is structured to resist that tax. In an era where policy is increasingly reactive to shocks, pandemics, wars, supply chain redesign, assets without counterparty risk earn a portfolio slot on first principles alone, regardless of price targets or chart patterns. And remember, the math we're doing is not about maximizing return. It's about minimizing regret. Regret comes in two flavors in retirement: regret of selling at the bottom and regret of watching your purchasing power leak away slowly while telling yourself it's fine. 50 ounces is a concrete antidote to both. Quick aside, if you're sitting on $100,000 or more in retirement accounts and you've wondered how people actually hold physical metal in a tax-advantaged way, I put together a simple free guide that explains how gold IRAs work, what custody actually means, how rollovers avoid tax penalties when done correctly, and the common mistakes to avoid. It's linked in the description if that's relevant to your situation. Worth skimming so you can make an informed choice and keep control over the details. Okay, back to the analysis. Let's stress test with some edge cases. Suppose the next 10 years bring disinflation and strong real growth. Stocks compound nicely. Bonds deliver decent coupons. In that environment, gold might underperform relative risk assets. Your 50 ounces still serve as a non-event emergency fund. You rarely sell any. You let the rest of your portfolio do the heavy lifting. You lose the opportunity cost on those ounces relative to, say, equities. But your overall retirement remains on plan, and your sleep at night factor stays high. Opportunity cost is the premium you pay for insurance you hope not to need. Now suppose the opposite. Stagflation light, slow growth, sticky inflation, periodic shocks. Equities churn, bonds struggle to beat inflation, real yields oscillate near zero or negative. Gold reprices in waves. In those waves, your 50 ounces are not just a shield. They're a sword you can use to cut through the worst stretch without sacrificing the rest. You may end the decade with fewer ounces, but in a stronger overall position. You've effectively harvested resilience. Skeptics will say, but what about dividends? What about tips? What about cash yielding 4 to 5%? All relevant. Tips can be useful, but they carry government calc CPI as the inflator and still embed policy and duration risk. Cash rates swing wildly and will likely be forced lower during slowdowns. Dividends are fantastic when paid and sustained, but they are not laws of nature. They get cut when earnings shrink. Gold doesn't grow cash flows, it grows certainty. It sits in a different lane entirely. Your retirement risk isn't just a spreadsheet, it's the probability that you will be forced into bad decisions at bad times. The right portfolio reduces that probability meaningfully. That's the goal. Let's do a few more numbers, because see the math means step-by-step clarity. If you have $1 million and allocate 50 ounces at $2,300, that's 11.5% of the portfolio, leaving $885,000 in traditional assets. If markets drop 25%, $885,000 becomes approximately $663,750. If you need $50,000 that year, drawing it from the $663,750 locks in damage. But if you sell 10 ounces, $23,000, and combine it with $27,000 from the portfolio, you reduce the forced sale by nearly half. If the market rebounds 20% the next year, that spared $23,000 participates in the rebound, recouping $4,600 more than if you'd sold it at the bottom. Over multiple such events, the cumulative difference can easily exceed $50,000 to $150,000. That's the real-world compounding impact of not panicking. Now push the envelope. If gold rises to $3,500 in a stress regime, a number easily mapped by plausible macro assumptions, the same 10 ounces yield $35,000. You'd only need to sell 6 to 7 ounces to cover a large portion of a year's spending. If gold breaks to $5,000 in an extreme policy error scenario, aggressive monetization, persistent negative real yields, reserve diversification accelerating, those 10 ounces become $50,000. You might deploy only 3 to 5 ounces in a crisis year and still meet your needs. Are these guarantees? No. Are they coherent, historically anchored pathways? Yes. Another layer people miss: taxes and placement. If you have taxable and tax-advantaged accounts, The placement of your gold exposure matters for after-tax results. Physical held outside accounts has its own tax treatment. A properly structured gold IRA or carefully chosen vehicles in a retirement account can defer or simplify the tax hit when you sell to fund spending. The point isn't to get lost in the weeds here. It's to recognize that after-tax math is often the difference between a plan that works on paper and a plan that works in life. When you're drawing $4,000 a month, a 10 to 15% tax drag versus a 25 to 30% drag materially changes the number of ounces you need to sell. Let's talk psychology, because numbers don't matter if your mind isn't steady. Retirement isn't a math test, it's a behavioral challenge. The moment markets drop and headlines scream, you will feel the urge to do something. If something means dumping stocks at the bottom, your plan suffers. If something means checking a vault statement, calling your custodian, and selling 6 ounces to fund the next 3 months while you make no other changes, your plan strengthens. Those ounces are a behavioral tool as much as a financial one. They help you replace panic with process. A word about sizing. Why 50 ounces? It's enough to matter and small enough to be practical. It's a round number that, at current prices, represents roughly $100,000 to $130,000 depending on the day. For many middle to upper middle class retirees, that's 8 to 15% of their investable assets. Could 30 ounces be enough for some? Absolutely. Might 100 ounces be appropriate for others? In certain cases, yes. But 50 is a threshold where the math starts to produce genuinely different outcomes in stress years without over-concentrating your exposure. It is, to borrow a phrase from engineering, a robust minimum. We should also acknowledge the counter-arguments honestly. Gold can be volatile. There are long periods where it underperforms equities. There are carrying and storage considerations. Liquidity in physical bars is excellent globally, but spreads exist, and speculation around paper versus physical can be overdone in calm regimes. All true. This isn't a romantic story about shiny rocks. It's a sober story about building a portfolio that can absorb policy error, inflation cycles, and volatility while you continue to live your life. The inconveniences are manageable. The benefits are profound. Let's craft a tactical roadmap. Simple, repeatable, and boring by design. Determine your annual baseline spending in today's dollars. Divide that by the current gold price to see how many ounces cover 1 year. For example, $50,000 divided by 2,300 roughly equals 21.7 ounces. Round up, 22 ounces roughly equals a year of spending at today's price. So 50 ounces is about 2+ years today. You're not going to sell it all at once. You're going to sell modest increments during dislocations. Next, think in 5-year clusters. Years 1 to 5 are most sensitive to sequence risk. Years 6 to 10 are pivot years. Years 11 to 20 are longevity years. Allocate an intended number of ounces you'd be willing to sell in each cluster if needed, say 12, 10, and 8 across clusters, leaving a cushion. That pre-commitment reduces emotional decisions. Now tie the strategy to triggers. For example, if my 60-40 portfolio is down 20% plus from its last high and my forward 12-month spending need exceeds the portfolio's 2% safe yield, then I will sell up to 10 ounces to cover the delta. Write it down. Share it with a spouse or advisor. This is how professionals operate, rule-based, not headline-based. It's also worth mentioning that gold doesn't exist in a vacuum. There are adjacent assets, silver, platinum group metals, that can play roles for some investors. Silver, for instance, has historically exhibited higher volatility and industrial sensitivity. It can spike in reflation cycles. But for retirement stability, gold is the primary anchor due to its reserve status and lower industrial beta. If you decide to complement gold with a small silver sleeve, be explicit about why. Perhaps to capture reflationary bursts or to opportunistically rebalance. But keep the core principle intact. The 50 ounces are for stability, not speculation.